I honestly believe that there is only one indicator that you need if you are an investor, and it will save you hours, days, and potentially weeks of your life if you use it and keep things as simple as possible. There's a reason this channel is called TC Trading, because we primarily talk about trading, we talk about tutorials, we talk about strategies, psychology. And when it comes to investing, there really just, in my view, there is not a lot to talk about. Because when you're getting into the weeds, there's a lot more weeds and nuance you can get into from the trading perspective, because there's so many things you can do, so many ways to go about it. And it's really tough to quantify this versus this is better than this. Like, you can't tell. Whereas investing, there's actually data, which we've talked about in previous videos, we've gone through. And what that data tells us is that the more active the investor, the poorer the returns. So if you were comparing to the S&P, there's a reason why most people cannot beat the S&P 500 over their lifetime. They'd be much better off just buying the S&P 500, and that's it. In this video, what I want you to take away is that your investing strategy could be really, really fucking simple. And you're probably overcomplicating it, but you don't have to. Think of it this way. If there was the potential to substantially outperform the S&P, and you get into the finance, the investing place on YouTube, and you start watching all these videos and people are talking about, investing in small caps and penny stocks, or doing this strategy, covered calls, or which, by the way, I'm not against covered calls. I love covered calls. I just think it's a little more advanced, and you can get to that point at some point, but it's not required by any means. But all these things, individual stocks, and it clouds you. It really throws you off, because it makes you think that, oh my gosh, if I learn this, and it'll improve my investing this much, and if I can achieve on average a 15 to 20% return per year, then that's incredible, and I can substantially outperform the S&P. And I get it, because I used to think the exact same way. But my thought process now is very simple. If I was to spend all this time getting into the fundamentals, into the weeds of investing, and trying all these different things, and I was able to beat the S&P a little bit more substantially from an investing perspective, more of a fundamental perspective, great. But how much time would that take me? How much of that time would I rather spend doing something else? How much of that time can I put towards trading and building a strategy and having an active income, which then I can reinvest? How much time can I put towards a business or work or whatever I want to do, a new skill, anything? How much of that time could I have used towards those things which make my life much more enjoyable? But also at the same time, statistics and history tells me, the numbers tell me that if I'm more active, there's a very low chance that I'll be able to consistently beat the S&P. So what if I just said, screw it, I'll take the S&P with just one minor tweak? This thought process is what makes me a little more excited about investing, because it's so simple, and it doesn't need to be crazy. The one indicator that you need is this right here. It's called the Fear and Greed Index. Now, this specifically is not like required. You want to have a sentiment indicator. The Fear and Greed Index is what I'm showing you here, and I'll show you a different one as well so you can kind of see. I will link up both of these indicators in the video description box below. Fear right now is showing on the Fear and Greed. It takes into account 7 indicators: momentum, strength, breadth, put-call ratios, market volatility, all these things. Do you need to know all of them? No, you don't. You could get into them. You don't need to know them. They have descriptions on the right-hand side if you want to dive deeper. You don't need to know them. I'm not going to waste your time. All you need to know is that when this goes into fear, and even extreme fear, and I'd recommend more looking at extreme fear, it's probably a buying opportunity. Now, we could go lower, and we have gone lower when the market goes there, but you're getting a much better dip buy, a much better value buy on the S&P than what you would be getting if we're in extreme greed or greed. And whereas most people want to invest more when we're up in greed and extreme greed, less want to invest here, but more money and more gains are made when you invest here. For example, let's go back to October and November of 2023. See how extreme fear was getting, tagged a couple of times? We were deep into fear and extreme fear. It's funny, where's the S&P at that point in time? Oh, right here. Would have led to a really good buy. Now, did we have to go up? No, if we were in a bear market, we would have gone down, but we at least would be buying a relative low. What's the other indicator? AAII Sentiment Survey, the American Association of Individual Investors. They come out with a survey every week that comes out Thursday mornings for the week ending the Wednesday prior. They essentially poll people and say, hey, what do you think about the market next 6 months, bullish, bearish, or neutral? And then they take the data and they publish it. We have historical averages. We have 1-year bearish highs, neutral highs, and bullish highs. And then we have the current week data, and we can compare that. When we see that bullish sentiment is low and bearish sentiment is very high, what can we do? Oh, I have some cash sitting around. Let's buy into the S&P. Guess what? The 1-year bearish high was week ending 11/1/2023. 50% bearish. That's a lot, right? Because the average is 31. It's a lot. It's pretty bearish. Guess what? That's this right here. So you see, like, it's not complicated, and you know this. This is not something that you don't know. I'm not trying to tell you like, oh, I'm trying to hammer the point home that you're wasting your time. In my opinion, the majority of you are wasting your time. I was too. I was too. I'll raise my hand. I was too for years. You're wasting your time trying to outperform the S&P from an investing perspective. Whereas you can do that maybe on a trading perspective. That's tough as well. It's not easy. With a strategy and you run your own strategy and system, okay, that's a separate point. You're wasting your time trying to guess where the market's going to go. If the bottom is in, should I buy options? Should I buy individual stocks? Blah, 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 blah. When you could ride the ETFs, ride the S&P, and utilize the sentiment indicators to buy the dip. Now, is that the only time you're buying? No. It could be, I guess, but I would recommend if you get paid twice a month, once a month, every week, when you get paid, have a recurring buy in your portfolio, which guess what? It's 2024. You can do this. Have a recurring buy in your portfolio that automatically buys an ETF. Could it be SPY? Could it be QQQ? Could it be DIA? IWM? That's the Russell, the Dow, the NASDAQ essentially, and the S&P. Or you can buy a Vanguard ETF, whatever your choice. Just buy a total market, total S&P ETF. Something along those lines could be great. A combination of a couple ETFs that cover different markets like tech, S&P, Dow, Russell could be good too. But you're not buying individual stocks. You're riding the overarching goal here is you're riding the overall markets. That's all you're doing. And you set those recurring buys up. And so every Monday, every Friday, whenever you get paid, you just automatically buy a piece. Let's say that recurring buy is $100 every week on Friday. I'd say I'd take that $100. I would take maybe $75 or $50, and I would just take that and recurring buy, boom. That extra piece, that extra $50 or $25 just gets piled up as cash in your account. Guess what? Cash is not a bad thing. I used to think that, oh my gosh, I can't. My money's got to always be invested. Why? My money does not have to always be invested. I'd rather have money when people don't have money so that I can invest it when others don't, and then reap the rewards of that investment later on. Again, if you were to do that back during the pandemic, you would have had money to invest back then. If you didn't, or back in the bear market of 2022, if you had cash, you could have been buying these dips more aggressively. If you were buying these dips more aggressively, guess what? Your account's probably at all-time highs by a long shot right now. Yeah, because market's near all-time highs, yeah. But if you're not buying those dips aggressively, your account's at all-time highs, but you could have made more. Could be up a bit more. You want to have cash, others don't. You don't know when these opportunities are. You don't know. I can't tell you when we're going to have this again. I can't tell you the next time we're going to go into extreme fear again. I don't know. But when you have a stockpile of cash for those times and for the next bear market, guess what? You'll be able to capitalize and buy the dip more aggressively when others can't, which will net you better returns. The average S&P returns over the past 100 years come out to about 10.64%. Let's call it 10%, just to make it easy. Technically, with inflation, it comes out to be 7.46. Okay, great, cool. I'm not talking about that. I'm talking about that. What is your return? 10%, Russ, let's just say. Do you think you're going to beat the 10% return if you're buying when everyone's greedy? Buying in times like this, buying it like, no. But do you think you're going to be able to beat that 10% return if you're buying more aggressively into fear? Are you going to catch the bottoms? No. But you're going to get the general gist and the general area of some of these relative lows? Yeah. A simple approach like that, I believe, will A, beat the S&P over your lifetime add in a couple minor tweaks. Maybe you want to sell covered calls, get a little more advanced, something we can dive into in the future if you're really wanting into it. I mean, you can substantially beat the S&P. Not saying that you're going to go out and target 25% year over year for the rest of your life. You could. People do it. It's not impossible. Chances are you're not going to be able to do it. And so I'm fine knowing that chances are I can't. So I'm going to ride this and then a couple minor tweaks, sell some covered calls. If I can get 12 to 15%, whew, I'm happy as a clam. Maybe that might sound aggressive to some. I think it's not with this approach and with selling covered calls. But that's a story for another day. Investing, I think, is very simple. I think that a lot of the stuff that you see on social media clouds you, throws you off. It's not meant. I think people mean well, but it's not necessary. It's too much. It's like all this crap that you don't need. You don't need to do that. You don't need to get into individual stocks. You don't need to get into like all these different crazy strategies and this and like, no. You don't need to know where the market's going. You don't need to know what the Fed's going to do next. You don't need to know that this is the bottom. You don't need to know that there's legs to the bull market. Like, you don't need to know any of that stuff. It's irrelevant. It's irrelevant. All you need to know is sentiment, and that you're dollar cost averaging, and that you're piling a little bit of cash for the times when sentiment gets aggressively bearish. Simple as that. Hope it was helpful. I'll see you guys in the next one. Peace.